Hello and welcome to episode 2 of the Lifespan Investment Series, where we discuss all things markets in terms of what's happening around the globe, and then we'll also touch on, in light of those events, what we're doing within our managed portfolios. Joining me again is Lifespan Investment Committee member, author, economist, and publisher of the Payne Report, Jonathan Payne. Welcome, Jonathan. Thanks again for joining us today.
Thank you, Eugene.
Today, we'll discuss global markets and we'll do a bit of a deep dive into China before then going back to discuss the local market in Australia, and then we'll touch on the portfolios. So, Jonathan, 3 months is a long time in investment markets, as you know. Hell, a week is a long time in investment markets. Back in April, we discussed what was happening in global markets and how bearish you were and potentially the whole investment committee was. And since then, things have kind of gone in the opposite direction to what we've expected. Markets have gone up, investment markets have gone up rather than down. So the question I pose to you is, in light of that, are you still bearish? And what do you think is going to happen over the next 3-6 months?
Well, thank you, Eugene, and it's great to get the opportunity of sharing my thoughts on the world. As you absolutely correctly identify, the last time I presented in this format, I was negative, I was bearish. If you recall, Eugene, we'd just come through the beginning of the regional banking crisis in the United States, and we'd seen the spectacular failure of Silicon Valley Bank, followed by a few others thereafter. And I took that as a sign that things were beginning to, kind of break and fall apart in the United States. I'm afraid, of course, as we now know, 3 months later, the US central bank injected $400 billion of liquidity into the system. And then, of course, we had that dramatic event in May, if you recall, Eugene, when NVIDIA announced the largest upward revision or upward guidance to revenue that we've ever seen from a major company pretty much in US stock market history. And obviously that also centered the market's opinion or perspective around artificial intelligence. So yes, since we last spoke, equity markets, particularly in the United States, have in fact performed pretty well. You then asked me the question, am I still negative? Am I still bearish? I am. I'm afraid I am still bearish. And the reason for that is because, of course, price earnings multiples in the United States have expanded quite significantly. And what is also noteworthy is we're just coming to the end of the second quarter earnings season, reporting season in the United States. And when all is said and done, we've still got a few more reports to come through. EPS, or earnings per share, for second quarter 2023 is going to be around about a -5%, -6% year on year. So what we've seen, Eugene, in the last 3 months is that, yes, the US stock market has gone up, particularly the NASDAQ, of course, which that has been driven by an expansion in price earnings multiples, not by an expansion in earnings per share per se. It's been driven by price earnings multiple expansion. And that concerns me somewhat, because I'm still of the view that the global economy is really beginning to slow down a bit, and we can explore that further, obviously.
Thank you for that, JP. So in layperson's terms, what you're saying, if I understood you correctly, is share prices have gone up, not because companies have reported better profits, but because investors have been prepared to pay a higher multiple for those profits that are there. Is that a fair
that is
summary
fair
of what you said? Yeah. Okay.
Yeah, cool. I would agree with that, because of course what we've seen is price earnings multiples now rising to 20 and 21 times for trailing EPS. So that's quite a high price earnings multiple. And I continue to be of the view that I understand that the recession hasn't arrived yet. And Eugene, you and I have had many conversations over many months about this. But at the end of the day, monetary policy acts with long and variable lags, and it's not instantaneous. economies don't go into recession a week or a month or even 3 months or 6 months after a rise in interest rates. It takes time for behavior to change. And so the other thing I just want to say to everyone is that I have acknowledged, and for people who read my weekly pain report, which is obviously weekly, I write it on a Saturday, I have acknowledged that the US household or US consumer has been somewhat insensitive to the rise in short-term interest rates. Why is that? Because US households are almost unique in the world because they can take out 30-year fixed rate mortgages. And we can see that many households in the United States basically refinanced when mortgage rates in the United States in 2020 and 2021 were very low. So we've got ample evidence that people were fortunate enough to lock in 30-year mortgages at kind of 2.5%, 3%, perhaps 3.5%. So the rise in short-term interest rates, obviously engineered by the US Central Bank, hasn't really impacted people with mortgages the way in which it is impacting, obviously, households here in Australia and obviously, for example, in the United Kingdom. So I've had to acknowledge that there is a greater insensitivity to higher short-term interest rates on the part of much of the US household sector because of that 30-year fixed rate phenomenon. So I have written about that in my reports as one way, I suppose, of trying to provide an excuse for not having sufficiently paid enough attention to that element of the American economic jigsaw puzzle.
Yeah, fair enough. I guess it is an important point, and it's a way that the US, I guess, housing market and interest rate market has a different impact on the consumer compared to Australia, where the vast majority of loans are variable or have very short fixed term periods. Okay, great. Let's pivot now to China. I want to talk about what's happening over in the Chinese economy. Now, we had the reopening of the Chinese economy post their COVID lockdowns sort of 6-8 months ago. And, you know, that provided a bit of a stimulatory environment for a period of time, but it's been a bit underwhelming. The other thing to talk about here is the Chinese central bank cutting the amount of money the country's lenders are required to hold in reserve in a bid to keep cash flowing through the economy. What are your thoughts on the current state of play in China, Jonathan?
Eugene, I'm spending an enormous amount of my time on China. As you know, I've studied China for more than 3 decades. And I think it was about 2 years ago that I said I've never been so negative on China in all the 30 years that I've studied it. And that observation 2 years ago was driven by my anxiety, my concern around the Chinese property market. And 2 years ago, of course, we saw the spectacular default by China's then largest property developer, Evergrande. And today, and in the last few weeks, all of us who watch China closely have been mesmerized by what's happening with Country Garden, which then became the largest property developer in China. And we've seen Country Garden's bond prices in the secondary market completely collapse. We've seen its share price listed in Hong Kong completely collapse. I mean, just to give you some round numbers, Country Garden 2 years ago as a share price was trading around 12 Hong Kong dollars, and it's now trading below 1 Hong Kong dollar. So that gives you the extent of it. Country Garden also failed to pay 2 interest payments on 2 of its onshore bonds at the beginning of last week. The economy now is officially in deflation. We saw consumer price inflation in China reported last week and declining on a year-on-year rate of minus 0.3. So we actually have an official deflation in headline CPI. And obviously producer prices have been negative year-on-year now for several months. So what on earth is happening? My view, and I've expressed this endlessly in my pain report for the last couple of years, in fact, is that we've seen the bursting of an epic property bubble in China. I've also written extensively about my belief that China, to me today, feels a lot like Japan did in the early 90s. We've got youth unemployment in China at 21.3%. Youth unemployment, 21.3%. We have seen, of course, deflation recently. We're seeing further evidence of a precipitous decline in land sales, in apartment sales. So if we believe the property bubble in China has finally burst, that has significant ramifications for the overall economy. Why? Because property, if you add together all of the contribution that property makes to the overall economy, estimates are between 20 to 25% of Chinese economic growth is driven by the property sector or companies related or servicing the property sector. So that's a big chunk of the pie. And what is surprising all of us is the hesitancy by Beijing to stimulate the property sector. But just remember this, Eugene, this is really important for us to remember, that coming into this much weaker property environment was the continued concern by the authorities in Beijing, and for several years now, that there was simply too much debt. And talking about too much debt, in the last few weeks, we've seen what we call local government financing vehicles. So local governments in China have for decades, obviously, basically derived most of their revenue out of land sales. And obviously land sales have been declining. And so unfortunately, we've now got a spotlight on so-called local government debt in China as well. So this is a fast-moving situation, but my bottom line is that China now is not going to provide the kind of engine of growth for the global economy that we've seen over the last decade. And just to finish this conversation around China, China's contribution to the growth in the global economy over the last decade is 40%. So 40% of the growth in the global economy has been driven by China's growth. So the United States is about 20% of global growth over the last decade, and the Eurozone in its entirety is around and about 10%. So let's be very clear that what is happening in China does not stay in China. I mean, and that's important. So yeah, I mean, I'd love to continue the conversation on China if you wish.
Sure. I mean, yeah, you could talk for a long time about China on its own, and that there are some staggering numbers. Over the years, whenever there's been a global crisis, well, particularly in the last sort of 15 years, we've been able to rely on growth coming out of China to help stimulate the rest of the world. In some ways, one could consider that what happens in China is probably more painful for the rest of the world than it actually is for China in some respects. But I think it's also very interesting that you say that China is actually in a deflationary environment. Let's not call it a spiral yet. When the rest of the world is either still trying to get inflation under control or in a disinflationary type environment. So that's all very interesting. And look, we've talked about the flow-on effects for the rest of the world from China's, potential slowdown. What about Australia? I mean, China is one of our biggest trading partners, perhaps less so in the last few years, but historically it's been one of our biggest trading partners here in Australia. Can we talk a little bit about how this slowdown in China might impact the Australian economy, the Australian share market, and then maybe touch on what you're thinking in terms of the local economy and markets in Australia?
Yeah, as you say, Eugene, Australia has been one of the greatest beneficiaries of this remarkable economic miracle that all of us have been witness to in China in the last 20 years plus. You might remember in 2003, Eugene, I used to say that China's a sleeping giant and it's awoken. And I used to also say the most significant and defining economic phenomenon of our time is the rise of the Asian middle classes, for they will shape and define the topography of the global economic landscape for decades. And that was 20 years ago. And let me just be very clear. the growth in the Asian middle classes is still an incredibly powerful economic phenomenon. So let me make that very clear. And there are other countries in Asia that I have been very, very positive about and will continue to be positive about, namely Indonesia, India, and Vietnam, spectacularly successful economy. So I just want to place our conversation in that context. My concerns about China today are that it has grown arguably too fast, too quickly. The debt levels are very, very high, and we're now beginning to see the property market unravel, and that will slow growth. Consequences of that will be that countries that export a lot to China, and we are in pole position in that regard, will clearly see a decline in the demand for our exports, principally iron ore, because that feeds through into infrastructure and property development in China. So what are the consequences for Australia? Clearly, if China slows, and I believe it will continue to do so, that will have a net negative impact on the Australian economy. Now, what does our own Australian economic jigsaw puzzle actually look like? Well, first and foremost, the most discussed economic item on the agenda is, of course, the so-called mortgage cliff. It is real as households move from fixed rate, short-term, fixed rate mortgages, 2 to 3 year fixed rate mortgages to variable rates. It is real. All of us know people that this is impacting. Yes, it is primarily impacting, unfortunately, the younger generation, the younger demographic, and also lower to middle income groups. Let's be honest, Eugene, a significant number of the high income groups have no comprehension of this conversation around mortgage cliff. They don't have mortgages. They're actually a beneficiary because they're earning higher rates on their short-term deposits with their banks. So, I mean, let's be very clear about this. Today, unfortunately, in Australia, the people that are being hurt are people that have big mortgages and also people who rent. And the proportion who rent and have fairly horrible mortgages is sufficiently significant for me to say that I think discretionary spending is on the decline. And the latest data that we saw at the end of the second quarter, Q2 quarterly data for retail trade turnover was negative. And in fact, it was 3 consecutive negative quarters. The last time that happened was 2008. And in fact, the Australian Bureau of Statistics highlighted that the last time we saw a year-on-year decline in retail trade turnover was 1991. So there is a negative impact here from higher interest rates. And at the same time, we've got these headwinds coming from China. So my overall look at the Australian economy, and it's horrible. You almost have your Australian passport taken away from you if you actually predict a recession. I am, yes, officially predicting a recession here in Australia, and I hope we can just navigate our way through it. I just continue to believe, Eugene, that after this seismic rise in short-term interest rates in such a compressed period of time, I'm afraid that's going to flow through, as we know from history. That kind of seismic rise in interest rates has an impact, and it's having an impact, I think, right across the economy. So I'm afraid, yes, I am in the Australian recession camp, and I hope Australians forgive me for that.
I'm sure everyone will forgive you, and look, it's our job to say what we think. So if we think there's going to be a recession, it's best saying that. I also think it's worth mentioning, in light of the recession and perhaps other factors, Chinese, the slowdown in China, etc. You're probably also pretty bearish about the Australian stock market.
Yes,
as with other global developed, at least, stock markets.
Yes, I'm afraid I am, and I think we're midway, not quite midway through our reporting season, and I think most companies are indicating that they see somewhat softer revenue growth moving ahead. So, yeah, we're right in the middle of that reporting season. I'm afraid I think the Australian stock market, I'm not massively bearish. I'm very cautious. I'm very conservative. And yes, I know we've got a very nice dividend yield, and that's very attractive. Although we now do have obviously the competition from higher short-term interest rates, which we've hardly ever seen before. And in some of the very higher quality end of the corporate credit market, you can get some very attractive yields. So I think a lot of investors are beginning to say to themselves, hang on a minute, what's the risk profile here? Maybe we actually get rewarded for being conservative for the first time in a very, very long time. And do we need to take that extra risk? Given what's happening in China, and by the way, I don't want to drag the conversation back to China, because as you know, Eugene, I love talking about China. I am a little concerned when I talk to a lot of people that they're not really paying sufficient attention to China. And I think China is a really important story right now. I know that I'm obsessed by it. I've studied it for more than 30 years. I read at least 4 Chinese newspapers a day. So, maybe I'm too close to what's happening in China, but I think I have an obligation to share with people such as yourself and your team, when my anxiety level about China is rising to the fore. And therefore, at the end of the day, if I see Australia, that has been such a massive beneficiary from this huge global economic locomotive, which is China, then I have to say, watch out, everyone. Let's just be aware of the fact that China's in a spot of bother here. And the kind of growth rates that we've all got used to, that is over. The demographics in China are absolutely appalling. We now have more people dying than being born in China. So the demographic factors, and they can't do much about that for in the short to medium term. The youth unemployment rates, the high levels of debt, and by the way, I didn't say in my earlier piece, business and consumer confidence in China at the moment is literally rock bottom. In fact, I've never, ever, even remotely seen business and consumer confidence as weak as it is. And I do speak to people that are very well placed to comment on China, and their level of anxiety about China and the direction of the Chinese economy is really noteworthy, and the worst I've seen in over 30 years of studying China. So I'm afraid the consequence of all of that is that we're not going to get the kind of tailwind from China that we've had and we've enjoyed for quite a long time here in Australia.
Yeah, no, China's definitely a huge piece of every puzzle, given its size and influence level. We touched briefly on interest rates, and I think it's a question that everyone has on their lips. In terms of interest rates, I think we're all pretty confident that we're either at the top of the interest rate rise cycle or very close to it. Maybe there's 1 or 2 rates. And I think, we've discussed this before, Jonathan. What's probably more important from where we are now in terms of interest rates is not necessarily where the end, where the top of the interest rate cycle is, but how long before we get some interest rate relief. How long before consumers get some relief on having to pay, an extra 4.5% on their mortgages, not to mention whatever other debts, business loans, etc. So, firstly, do you just want to confirm whether or not you agree that we're near the top of the rate cycle? And what are your thoughts in terms of, when we might start to see rate cuts?
Yeah, this is such a critical issue, Eugene, and I think the way you phrased it is appropriate. It's not so much where the end point is, because I think we're pretty much there. It's how long we stay up there. And that, I think, is really important. And this is where it gets a little bit complicated. Let's break it into different pieces. First and foremost, I think we're pretty much there. I don't believe personally that the Reserve Bank has much appetite to inflict a lot more monetary pain on Australian households. I mean, we know that Philip Lowe is leaving us in September, and his replacement, Michelle Bullock, who's been at the RBA, by the way, for I think 30 years. I don't think either of them really want to continue to impose this kind of monetary pain on the Australian populace. So with Philip Lowe leaving, is there going to be a massive changing of the guard at the RBA? I don't really believe so. Are we near the end point? Are we near the high point? I think we're very close. We may get one more. Lowe might, in his last meeting, which is still ahead of us, might put in one last 25 basis point move so that his successor, Michelle Bullock, doesn't have to actually tighten as soon as she arrives in the role. So there's that element. The bottom line is this: the bigger question to me, as you correctly phrased it, is how long will we stay there? How long is it before Australians get some sense of monetary relief? And that is really tough. My instinct right now tells me the central banks want to keep rates higher for longer because they believe it's an asymmetric risk-reward trade-off. They believe the risk of lowering rates too soon is greater than keeping them high for too long. There's so much in that that we'll have to try and let's just try and dissect that. So their fear is, and all central banks have this fear, particularly in the United States, is that inflation begins to look like it did in the 1970s. In the 1970s, what haunts the central banks today is a replay of what happened in the 1970s. And let's just very briefly remember what did happen. We had a surge in inflation in the early 70s. Inflation then rolled over on a year-on-year basis because of the base effect, and we all know what that is now. And then it started re-accelerating. And it was that second wave up that really caught the US Central Bank in the United States off guard, and it was Arthur Burns, who was the Fed chair at that time. The rest is history. Inflation continued to surge through the latter part of the 70s, and of course, it wasn't until Paul Volcker arrived in the early 80s that he slayed the American inflationary dragon. Central banks in London, in Europe, in the United States, and here in Australia and elsewhere don't want to run the risk of that. So they are tempted to keep rates higher for longer until they've really, really compressed or suppressed inflation and, importantly, inflation expectations. I think they've been quite successful so far. And in the United States, we saw a very sharp deceleration in the year-on-year rate of change, namely from 9.1% headline CPI down to 3%, and we just ticked up a little bit to 3.2%, mainly driven by a base effect, incidentally. But overall, I think inflation is going to be reasonably well contained. One of the things telling me that is because the monetary aggregates now, money supply right around the world is actually rolling off a cliff. Why? Because, of course, we saw that massive surge in money supply in response to COVID, and we're now seeing a deceleration in the rate of change in money supply. So let's try and put all that together. And the inflationary jigsaw puzzle, Eugene, as I've shared with you many times, is the most complex puzzle of them all. So at the end of the day, we know goods prices are declining. And on that front, quick observation, I think every manufacturing a nation in Asia and major exporter are going to be exporting furiously in the next 6 to 12 months to try and outcompete each other. And I think that's going to put a lot of downward pressure on capital goods prices. I'll use one highlight: electric vehicles. Watch this space. Chinese EV makers are slashing prices, and they're going to flood the global automobile market with electric vehicles. They're going to flood. It'll be like Japan in the 70s and in the 80s. So that will drive down the price of electric vehicles. But the bottom line is all the great manufacturing nations in Asia, and we know who they are. Obviously China, obviously South Korea, obviously Japan, and then we've got now Vietnam and others. All of these countries are going to be selling as much manufactured product into the global economy as possible. That's going to drive prices down on capital goods. And in the meantime, the West, if we use Europe, the United States, and other countries, we're going to see diminishing demand. Excess supply meeting diminishing demand equals lower capital goods prices. This is important. However, on the other side is the services inflation, which we know is historically a lot more sticky. Inside service inflation in the United States, we've got shelter. Remember, we used to talk about owner's equivalent rent. Don't worry, Eugene, I'm not going to bring that up. But the bottom line is wages are also somewhat sticky, because for the first time in a long time, people around the world are saying, you know what? There's a shortage of labor. That means we can demand higher wages. So the tension in the inflationary dynamics is lower capital goods prices driven by massive exports out of Asia. However, we're going to have sticky service inflation, particularly in the wage sector. So try and work that one out, and then we know where inflation is going. The bottom line for me is that the central banks are concerned about the stickiness of wage inflation and service price inflation, and hence will keep rates higher for longer. That's going to put even more downward pressure on the respective economies. So in answer to your question, which I've taken probably half an hour to reply to, Eugene, my apologies as always, you asked the question, when will we see monetary relief? I think it's quite delayed. I don't know exactly when it's going to happen, but I think right for the remainder of this year, no rate cuts, pretty much anywhere. To the United States, UK, Eurozone, Australia, and then into next year, let's watch the economic jigsaw puzzle. But the central banks are going to be more reluctant to cut until they feel they've vanquished, extinguished the inflationary dragon, which has so embarrassed them. Because 2 years ago, they told us it didn't even exist. It was a mythical figure, had never come out of the cave. Then the dragon came out of the cave, and the central bank said, oh my goodness gracious me, what are we going to do about that? And they raised rates dramatically, and I'm afraid that's where we are today.
And so, and look, it is very difficult to predict, the timing of what's going to happen with rates. I note that only 3, 4, 5 months ago, bond markets were pricing in rate cuts before Christmas. I would say that's almost impossible now. But I think the point to take away from this is your view, Jonathan, is that central banks care more about getting inflation under control and lowering inflation than they do about damaging the economies by keeping rates too high at this point in time. Once we see significant damage to economies, that view might change, if and when we see that. But for now, they're likely that your view is, and we would tend to agree with this, they're more likely to keep rates higher for longer, and just treat economic fallout as collateral damage, because they're afraid of a second wave of inflation like we had in the 70s, which is a disaster. Like that would exacerbate this current inflationary crisis that we've had. Okay,
Eugene, you've just summed it up so well, and you took 1 minute and 5 seconds, and I took 10 minutes. So next time you should answer your own question, because you summed it up a lot better than I could have done. You're absolutely right in what you just said.
Appreciate that coming from you, Jonathan. So we've had a great discussion about all things markets. Let's tie it back to the lifespan managed portfolios that the investment committee manages and you have an input in, along with other investment committee members. How are we, just talk briefly about how we're positioned, and have we made any changes over the last 3 months in light of some of the things we've discussed today?
No, I think we've been conservatively and defensively positioned. In fact, we were last quarter, and we continued that into the second quarter. I mean, clearly, I need to acknowledge to everyone watching and listening that my view on the US equity market, and you remember this, Eugene, and I think it was even before I became a member of your investment committee, but at the end of 2021, I know that's an eternity ago, I was very, very negative on the US market and looked for a 20 to 25% decline. We got that. I then basically came out, I don't know what I was trying to be, a hero or something. I should never try and be a hero, Eugene. It's dangerous. And I then called for that 3,000 S&P 500 target. And that number has been a bullseye on my back ever since. And I can't tell you how many arrows I have in my back. Just to remind everyone, because this is, I think, preceding when I joined your committee, The 3,000 S&P 500 target, which I had for 2023, which is obviously the current year, was predicated or built upon a price earnings multiple of 15 multiplied by earnings per share of $200 for calendar 2023. I know that's a mouthful. So 15 times 200 equals 3,000. And I've kept to that target. And I just say that we're in August, so there's still 4 months to go. What is the likelihood of that target being met? It's probably very, very unlikely, although stranger things have happened in life. Anyway, the bottom line is I've maintained a conservative and defensive view of markets because, of course, we're being rewarded for the first time having some exposure to fixed rate assets and particularly high quality assets. So the recommendation and the opinion has been basically favoring a longer duration, high quality government bonds, particularly here in Australia versus the United States. And I think if you actually have to make a choice between Australia and the United States, you tend to favor Australia because we don't have the budget deficit kind of issues that we have in the United States, which has really been brought to our attention or re-impressed upon us by the downgrade by the Fitch credit rating agency of US sovereign debt. So at the end of the day, I think a conservative, defensively positioned portfolio is still appropriate, given some of the conversations we've had already. Namely, we're going to see these central banks keep rates higher for longer. We've got negative headwinds coming out of China. We haven't had time, and we won't probably have time today to talk about the Eurozone. But don't forget, the locomotive of the Eurozone, Germany, is in recession. I mean, we kind of conveniently forget that every now and then. And sadly, the UK is heading in that direction as well because of interest rate impacts, particularly through the mortgage market. So at the end of the day, I think a conservative defensive position and a very well diversified portfolio is appropriate in this kind of environment. I think price earnings multiples, particularly in the United States, are at the higher end of their historical averages. And so therefore, I think a more defensive kind of positioning is appropriate. One of the things about financial markets, which after, I don't know, when did I start in this market? 1984, is investors have this really curious habit of basically selling when markets are really cheap and buying when they're really expensive. And we do the opposite. So if you walk down a high street and there was a sign saying, okay, everything's half price, and no one went into the store because, of course, it was just too cheap, then the next week there was a big sign saying, we have doubled our prices, everything's unbelievably expensive, come in and buy, and everyone flooded into the store to take advantage of those much higher prices. You and I would both say, well, that's just ridiculous, but that's what we do in the markets. Historically, that's what we do. And we know in the US right now, everyone is all in. And I could go on forever about this, but the CTAs are all in, the fund managers are all in, everyone is all in. All of the sentiment surveys are telling me that. The option crowd, all of them are all in. Call buying massively outnumbering put buying. All of the sentiment ratios in the US are telling me, watch out here. And we haven't talked about commercial real estate and the other things in the United States. But at the end of the day, I still think a conservative defensive portfolio is really appropriate in this kind of environment. Looking at the fundamentals, if you're driven by sentiment, yes, of course, you're going to be all in. And that's what I think has basically driven people into the market in the last few months.
Okay, thank you for that, Jonathan. So I guess to summarize, we haven't made any real changes in the last quarter, largely because we're already positioned in the way you described, underweight equities globally, underweight listed property, overweight longer duration bonds, high quality bonds, emphasis on quality. It's definitely not the environment in our view where you want to have low quality bonds at this point in the cycle. And potentially the only change we're looking at in the short term is to add to that bond portfolio and possibly also, to moderate how underweight we are in our tactical strategy. We may move from being extremely underweight to just very underweight, but still remaining incredibly cautious and diversified is also very important. Is important because you know, if there is a shock due to some of these things, you know, often the shock can be concentrated in one sector, one country, one type of market. So that's where diversification becomes really important to minimize any fallout from that. All right, great. Well, look, I think it's been a great discussion. Thank you for all of you for tuning in, and hopefully you've made it to the end of this. And look forward to seeing you again and talking to you again in 3 months' time, everyone. And Jonathan, thanks again for joining us, and look forward to the next one.
My pleasure, Eugene. Thank you very much. Thank you, everyone. Thank you.
Thanks, everyone.